Hello everyone, welcome to today's lecture. So today we are going to cover audit of consolidated financial statement. Okay, so what is audit of consolidated financial statement? How it is different from the standalone financial statement? That's very important to understand. Before I dive into the particular topic, what I'll be doing is I'll explain you certain terms that I will be using throughout this particular lecture, and that is very important to understand. Okay, so let's start this lecture. Okay, so before I start, as I said, so the first time I just want to understand, want to make you explain or understand is parent company. Pretty easy. We have already seen these terms in before also, in past also. Just to revisit these terms or just to explain you again, so that you can have that level of clarity when we are discussing these terms in this particular lecture. So parent company is nothing but, you can say, holding company, okay, or the company which is actually is exercising the power, voting power, or power on the management of a subsidiary company. So it's a holding company of subsidiary company, or you can say it as a one or more subsidiaries. That's a parent company. Now I will be same parent company, holding company. So these terms will be used interchangeably. Okay. Then comes the ultimate holding company, and intermediate holding company. Okay, ultimate holding company and intermediate holding company. Now what are these companies? I'll explain this with an example. Let's say, for example, X Limited. X Limited has a fully owned subsidiary. Okay, Y Limited. Now Y Limited has 4 subsidiaries. A Limited, B Limited, C Limited, and D Limited. Now let's say again, out of this, C Limited has 2 more subsidiaries. DA Limited and DB Limited. Okay, so now the term ultimate holding. Now when I say ultimate holding company, it will be X Limited. Because X Limited is the holding company, ultimate holding company for all the companies. It may be through via other companies, but still it is a ultimate holding company, holding for everyone. Now when I talk about intermediate holding company or intermediate parent, basically both terms are used interchangeably. So when I say intermediate, it differs from whose perspective we are looking at. So for example, DA Limited. For DA Limited, intermediate holding company can be my C Limited, can be my Y Limited. So both are my intermediate holding companies. Okay, so both are my intermediate holding companies, C Limited and Y Limited. And when I talk about C Limited, only Y Limited will be intermediate holding company. Okay, now this whole particular structure or group, particular group of companies is also known as a group. Basically we call this as a group. group of companies, or you can say group only. Where X, Y, A, B, C, D, D, A, D, V all together will be known as a group. Okay. Now I'll talk about consolidated financial statement. Consolidated financial statement, simple. You have a standalone financial statement of DA, DB, okay, B Limited, A Limited. But when you together prepare the financial statement of the group, that becomes your financial statement, consolidated financial statement. Okay. I hope it's clear till now. Okay. Again, now there is one more term that I want to explain is principal entity and component. These two terms basically you will see in standard like let's say SA 600 or somewhere in the materiality SA 320. So you will see this term frequently. Or you will see this particular term in NDS 110. So this term, principal entity and component. When I talk about component, so principal entity will be this one, X Limited. But when I talk about component will be the subsidiaries. So component is equivalent to the subsidiaries over here. Okay. So I call it subsidiary, I call it a component. So both are same, perfectly fine. Okay. Now, this was just understanding of certain terms. Now I'll come to the basic provision from where it is starting. So today, let's say for example, I have a holding company, I have some subsidiaries, a group is there. For example, the earlier example group, X, Y, A, B, C, D, this one. Let's say I have this particular group, X, Y, A, B, C, D, D, A, D, B. Why I am required to prepare the consolidated financial statement? Who asked me to prepare it? So the responsibility to prepare the consolidated financial statement is coming from Companies Act. That is section 129. So section 129 says that when a company has a one or more subsidiaries, then in addition to the financial statement that the company is preparing for itself, they should prepare a consolidated financial statement, which again should be laid before the annual general meeting of the company, like the other financial statements are required to be done. Along with that, a separate statement containing salient features of the financial statement of its subsidiary or associate joint venture is required to be prepared and filed with MCA ROC in form AOC1. So a separate statement containing salient features of the financial statement of subsidiaries, joint venture, associate shall be there in form AOC1. Okay. Now, just to show you form AOC1, this is form AOC1 that has been prescribed, where we need to provide a statement containing salient features of the financial statement of subsidiaries, associate, and joint ventures. So this form has two parts. Part A for subsidiaries, where you need to provide name of the subsidiary, date, reporting period of the subsidiary concerned. It's different from holding companies reporting currency, exchange rate. Then when I talk about salient features, it is like share capital, reserve, total asset, liabilities, investment, turnover, profit before, provision, after taxation, proposed dividend, extent of shareholding. And along with that, you need to provide name of the subsidiaries, which are yet to commence operations, and name of the substitute which have liquidated or sold during the year. Same way, you have a part B for joint venture and associates, okay, which talks about latest audited balance sheet, date on which associate or joint venture was acquired, share of associate or joint venture held by the company, okay, amount of investment in associate, extent of holding, describe how there is a significant influence, because now the concept of significant influence is there instead of what you say, holding. Reason why the associate or joint venture is not consolidated, net worth, profit and loss, consideration in consolidation, not considered in consolidation. So all these things are required to be provided in this form. So this is AOC1, where you need to provide salient features of subsidiaries and joint ventures. So Companies Act 129 says that you need to prepare a consolidated financial statement, plus you need to share or you need to file a salient features of financial statement in form AOC1. That is there. Okay. Same is applicable for the government companies also. So the government companies are also required to file form AOC1. Now, how to prepare consolidated financial statement? I know I need to prepare, but how? Okay. How to prepare the consolidated financial statement? That is prescribed under 129(4) of Companies Act. 129(4) says that the provision of this act applicable to the preparation, adoption, and audit of financial statement of holding company shall apply to the equal level to the consolidated financial statement. Shall apply to consolidated financial statement also equally. Okay. Now, when I talk about equally, then it comes, there is a reference, then it comes to the rules of company's account rules, wherein it is said that the consolidated financial statement of the company shall be made in accordance with the Schedule 3 of the Act. Schedule 3 of the Act. Okay, very important. Because Schedule 3 is the one that prescribes you, okay, the format of financial statement. Now, it is said that it should be prepared as per the Schedule 3 of the Act. Okay, fine. If you see the Schedule 3, if you see the Schedule 3, okay, what Schedule 3 says? Schedule 3 has 3 parts. Either it's a Division 1, Division 2. They have a 3 parts. Part 1, balance sheet, part 2, P&L, part 3, consolidated one. Okay, and that part 3, basically generals, there is a general instruction in the part 3 which says that, okay, for the consolidation one. So that's there in the schedule. Just a minute. Okay. I'll explain you in the schedule in detail once we'll reach there. Okay. Now, and I know I need to prepare as per the Schedule 3, my consolidated financial statement that is there. 129 asks me to prepare it. 129(4) requires, to be prepared as per the Schedule 3 that is there. And now comes the very important area. There is an exemption given in Ind AS 110 that certain companies are not required to prepare consolidated financial statement. What is Ind AS 110? Consolidated financial statement. Or on the same line, you have a AS also. So there is an exemption given under Ind AS which says that there are certain companies who are not required to prepare the consolidated financial statement. Now, what you will do in that case? There's a conflict. Ind AS gives you the exemption, and this particular section 129, or basically the rules, ask you to prepare. Now, if they ask you to prepare section 129 and Ind AS gives you exemption, what you will do? Which one you follow? In that case, where there is a difference between, like Ind AS and particular the provision of Companies Act, usually 99% there will not be a difference. Here is also a proviso, a exception is given in the Companies Act, which says that provided that in the case of a company covered under subsection 3 of 129, that is, who are required to prepare consolidated financial statement, and which is not required to prepare consolidated financial statement under accounting standards. Okay. So if you are not required to prepare consolidated financial statement under accounting standard, it shall be sufficient. It shall be sufficient if you comply with the provisions of Schedule 3. Okay. So no need to basically prepare the whole consolidated financial statements. It will be sufficient if you comply with the Schedule 3. When you have been given exemption under companies or under Ind AS, then you need to comply with the only Schedule 3. Okay, let me explain. Let's say company having subsidiaries. Now this company is required to prepare CFS. This company is required to prepare CFS, but we will check one more thing. Before we can say this company is required to prepare CFS, what we need to check is, we need to check whether the exemption under Ind AS 110 is available. Now there is another exemption, whether the exemption under rules is available. Okay. So I will check these two things before I can say, okay, this company is required to prepare CFS. If I say yes for this particular thing, then what they need to do is comply only with Schedule 3. Comply only with Schedule 3. So we are not required to prepare the full set of financial statement. Simple. We are only required to comply with the Schedule 3. Okay. We are only required to comply with the Schedule 3. Okay. Now, if no, basically, so I'll tell you in that case what will be the scenario. Yes, no. Then again, no exemption available. But if exemption is available, exemption which is there under the rules is available. Okay. Then if you are exempted as per the rules, again, same, you need to comply with only Schedule 3. No need to comply with what you say. No need to prepare separate set of financial statements. Only comply with Schedule 3. But if I say no, then in that case, full set of consolidated financial statement are required to be prepared. Full set of consolidated financial statement are required to be prepared. Okay. If there is no exemption available, then you are required to prepare the full set of consolidated financial statement. Now, which are these exemptions I'm talking about? Okay, let us discuss first the Ind AS 110 exemption. So, Ind AS 110 says that an entity that is a parent shall present consolidated financial statement except where, like, there is a provided that parent need not to present consolidated financial statement if it is a wholly owned subsidiary or partially owned subsidiary of another entity. Okay, and all other its owners, including those who are not entitled to even vote, means all its owners have been informed about not presenting consolidated financial statement and they do not object. They do not object. Okay, we are fine with that. Number two, its debt or equity instrument are not traded on the public market, nor it is in the process of filing for IPO or for listing. Last one, its ultimate or intermediate parent, okay, produces financial statements that are available for public use and comply with Ind AS in which subsidiaries are consolidated. So its ultimate or intermediate parent already prepares the financial statement, consolidated financial statement, okay, which has all the details of its subsidiaries. Clear? So if these four conditions satisfy, then you have a exemption under Ind AS 1110 for not to prepare financial statement, consolidated financial statement. Same way, there is an exemption under rules. Rule 6 of Companies Accounts Rule 2014. Which says that nothing in this rule shall apply, okay, in respect of preparation of consolidated statement by a company if it is a wholly owned subsidiary or subsidiary of another company. All its other members have been intimated in writing. They do not object to the company not presenting consolidated financial statement. Company whose securities are not listed or not in process of listing, its ultimate or intermediate holding company files consolidated financial statement with registrar which are in compliance with the accounting standard. If you see, both are same in major extent. Here, this one basically, this combines to one in rules. If you see, debt and equity statement, equity instrument are not traded in public market, or it's not in process of filing. If you see, it says that company whose securities are not listed or are not in process of listing. The last one, it says that they produce the financial statement that are available for public use and comply with Ind AS. And here, if you see, it says that its ultimate or holding company files consolidated financial statement with registrar which are in compliance with the applicable accounting standards. Pretty much same. So if you have any of the exemption, you are not required to prepare the consolidated financial statement, and in that case you need to only comply with the schedule 3. Only comply with the schedule 3. I hope I'm clear. Any doubts? Any doubts till now? Very important to understand. See, first of all, we need to understand when consolidated financial statements are applicable, okay, and when they are not. Then only you will be able to, appropriately audit them. Okay. So very important this point to understand what is the applicability of the consolidated financial statement, from where it is working, how, which rules are applicable and which section is applicable. Okay. If no further doubts, let me move forward then. Now, these were the provisions of Companies Act and basically Ind AS 1110. However, there is few more things that we need to understand. There is another exemption which is given for the investment entity. Okay. What is that exemption? We need to understand. Okay. When I talk about investment entity, so entity like which is an investment entity is not required to prepare consolidated financial statement. A parent that is an investment entity shall not present consolidated financial statement. So investment entity is not required to present consolidated financial statement. So there is a third kind of exemption I can say over here. If investment entity, then again, if yes, okay, so this will fall under the category, again, this one. Because they are provided exemption under the Ind AS for not to prepare consolidated financial statement, but still they need to comply with the minimum requirement of Schedule 3. So you need to comply with the minimum requirement of the Schedule 3 overall. Okay, although if you are exempted from the Ind AS. So that was one thing. Now, the important question comes is, what is an investment entity? We need to understand what is an investment entity, from where it is coming. See, investment entity, there is a definition given of the investment entity in the same Ind AS 110. Okay. Now, that talks about investment entity is the one which obtains the fund from one or more investors for the purpose of providing them with investment management service, or it commits to the investors that its business purpose is to invest funds solely for the purpose of returns from capital appreciation, investment income, or measures and evaluates the performance of its substantially all of its investment on fair value basis. Okay, if that is the one, then that is known as an investment entity. And an investment entity is required to measure, or what do you say, invest or measure an investment in the subsidiary through fair value through my P&L, that is as per Ind AS 109. So investment in subsidiary is required to be measured at fair value through P&L in accordance with Ind AS 109. Okay, that is an investment entity. However, there is a catch, like exception to that exception, which says that if a parent of an investment entity, okay, if a parent of an investment entity is not an investment entity, then they need to consolidate all the entities which are through investment entity also. So for example, in our earlier example, let's say this one, X, Y, A, B, C, D, D, A, D, B Limited. Now I say in this current example that Y Limited is my investment entity. This is my investment entity. So I'm not required to prepare CFS. I'll only compile Schedule 3. Now X Limited, what X Limited will do? Y Limited is not preparing any CFS. Should X Limited prepare CFS? And if yes, then what it will consolidate? Will it consolidate A, B, C, D, D or D, A, D, B, because they are the subsidiary of Y, or X Limited will consolidate only Y? So as per you, what it should do? When X Limited is preparing its financial statement, should it consider only Y Limited or all the entities? Good, Kaushiki. So what should X Limited do? Should it consider only Y Limited or all the entities in the group? Correct, Kaushiki? Pretty simple, guys. Correct, Bonnie? Come on, guys. Correct, Hari. Good, Swam. Okay. So the case when, okay, in the case when X Limited is ultimate holding company and Y Limited is an investment entity, Y Limited will be exempted. We just now saw. But when X Limited is preparing its financial statement, he needs to consider all the entities A, B, C, D, D, A, D, B, and Y Limited, all the entities. So, India's itself says that a parent of an investment entity shall consolidate all entities. Okay, all entities, including those that are controlled through an investment entity or subsidiary, unless the parent itself is an investment entity. So if parent itself is an investment entity, then it's fine. Then they are not required to, because again they will have an exemption. But if parent is not an investment entity, then it will be required to consolidate all the entities, including those one which are through your parent entity or through your investment entity. I hope it is clear. So all the entities are required to be consolidated. All the entities. Okay. Now, now this was with respect to the investment entities or the exemptions which are available under NDS 1110 or section 129 that we discussed. Okay. Now, what I'll do is I'll take one example. We'll discuss certain things in detail, and accordingly, one by one, we'll go to that particular topic. Okay, we'll go in this particular chapter with this particular example or case study sort of thing, so that you can have a good understanding or clarity what I'm talking about. ABC Limited acquired 75% equity shares of PBC Limited and DBC Limited on 31/5/2021. On 36/2022, ABC Limited acquired 100% stake in ANO Limited, which is a Cyprus entity. ABC Limited was fully owned subsidiary of XYZ Limited. XYZ Limited was engaged in manufacturing construction equipments and heavy automobiles. Okay. While preparing the consolidated financial statement of XYZ and ABC Limited, the statutory auditor identified the following things. First, the inventory valuation and inventory provision accounting policies followed by XYZ, ABC, PBC, DBC Limited was different than the accounting policies followed by ANO Limited. As per Ind AS 110, consolidated financial statement, if in a consolidated financial statement, if a member of a group uses accounting policies other than those adopted in consolidated financial statement for the like transactions and even in the similar circumstances, appropriate adjustments are made to the group members' financial statement in preparing consolidated financial statement to ensure conformity. So again, if in a consolidated financial statement, okay, member of group uses accounting policies other than adopted in consolidated financial statement, accounting policies other than which are used in the consolidated financial statement, like here in the current case, okay, inventory valuation and inventory provision accounting policy followed by XYZ, ABC, PBC, DBC was different than followed by A&O Limited. So in a case of consolidation, when member of a group uses accounting policy, so member of a group uses accounting policy other than adopted in consolidated financial statement, then appropriate adjustments are required to be made to the group members' financial statement. That's Ind AS 110 says. Okay, that is as per Ind AS 110. To ensure conformity with the group's accounting policies. Okay, hence management of XYZ Limited passed the adjustments to align the different accounting policies in consolidated financial statement. So that was done. Okay, so they passed the adjustment. Now I'll come to the question. Okay, one more thing before going to the question, that ABC Limited and XYZ Limited were appointed CKC and Company Chartered Accountant as their statutory auditor, whereas PBC DBC Limited appointed NKL Company their statutory auditor. However, A&O Limited was not audited by any auditor. Okay, let me come to the first question. CKC and Company were of the opinion that they are required to prepare consolidated financial statement for ABC Limited and XYZ Limited. However, management of XYZ Limited contended that they should prepare the consolidated financial statement of ABC Limited as its investment company. Kindly guide CKC and Company with respect to applicability of the consolidated financial statement. Also, there is one more information given that ABC Limited's prime object was to invest the funds of its shareholder for the purpose of capital appreciation and investment income. Okay, so that was the ABC Limited purpose. Now you tell me here. So here CKC was of the opinion that they need to prepare consolidated financial statement for ABC and XYZ. Management said that no, you should prepare only for ABC. What is the correct option over here? So these are the four options. You need to tell me what is the correct option and why. So the first option is subject to the provisions of Rule 6. For a company, if it is ultimate or intermediate holding company, files consolidated financial statement with the registrar which are in compliance with the applicable accounting standard, then company is not required to prepare consolidated financial statement. Okay. Okay. If for a company, if it's ultimate files consolidated financial statement, then the company is not required to prepare consolidated financial statement. For a company, if it's ultimate or holding does not file, then company is not required to prepare. For a company, if it's ultimate or holding company, okay, files the consolidated financial statement with registrar, okay, then company is also required to prepare consolidated financial statement. For a company, if its ultimate or holding does not file, okay, then the ultimate or holding company is required to prepare consolidated financial statements. So which one option is correct from here? Pretty easy, guys. Correct, Kaushiki? Also, you tell me whether XYZ Limited and ABC Limited, out of them, which entity is required to file consolidated financial statement and which is exempted. Correct, Boni? Again, I'll reiterate the whole example. ABC Limited acquired stake in PBC Limited and DBC Limited. ABC Limited also acquired 100% equity stake in ANO Limited. ABC Limited is a fully owned subsidiary of XYZ Limited. XYZ Limited engaged in manufacturing of construction equipments and heavy automobiles. Whereas ABC Limited prime object was to invest funds of its shareholder for the purpose of capital appreciation. Now you tell me which entity out of the both is required to prepare consolidated financial statement, ABC and XYZ, and why? Correct, Kokshiki? Absolutely correct. Come on, guys, pretty easy. So in the current case, basically, okay, sorry, yeah, in the current case, basically what is happening is ABC Limited is an investment entity and XYZ Limited is a parent of that investment entity. If an investment entity is not required to file, but when it comes to the parent entity, okay, then parent entity needs to consolidate as per the rules plus as per the NDS, okay. So XYZ Limited will be the company who will be preparing the consolidated financial statement, and he will be, that entity will be the one that will be preparing consolidating all the entities which are even part of the ABC's group. So XYZ Limited will be the entity which will be preparing consolidated financial statement. And when it comes to the rule, it says that for a company, if it is ultimate or intermediate holding company filed consolidated financial statement, okay, and the company itself is not required to file consolidated financial statement, then the company is fine. Like they are not required to prepare consolidated financial statement. Clear? So for the first one, the answer is A. I hope it is clear. Correct, Boni. Correct, Kaushiki. So there was a question. If in earlier example that I was discussing, okay, in terms on here, this example, if X is an investment entity and Y is a not, then is Y required to prepare CFS? So the answer of this lies under here. I'll tell you. See, in section E1 or the rule, it says that if it's ultimate or any intermediate holding company files consolidate. So if any of the company which files consolidated financial statement from the group, okay, whether it's a ultimate or intermediate, then it is fine. And in the case of NDS 110, the company investment companies are exempted. So in that case, if in the current example, this one, if X Limited is an investment entity, then Y Limited will be required to file the consolidated financial statement. But you need to understand that even though they are exempted from preparing the consolidated financial statement, they have to comply with the minimum requirements of Schedule 3. Okay. I hope it is clear. Any doubt? Boni, can you rewrite your question? I just want to understand further detail in that. Any further doubt? Okay. If no further doubts, what I'll do is I'll move forward to the next topic. Second question. CKC and company were of the opinion that there is no need to audit the adjustment passed in the consolidated financial statement for the different accounting policies pertaining to valuation of inventory and provision, as this is not part of the original financial statement. Kindly guide with respect to the audit requirement for consolidated financial statement. Now, this is with respect to inventory adjustment. Okay. So you tell me, okay, I'll read the options. Auditors should gain the understanding of procedures adopted by management of the enterprise to make the above mentioned adjustment. Okay. This helps in the auditor in reducing the audit risk to acceptably low level. The auditor should not gain understanding. This will not help the auditor. Entity's financial reporting process also includes use of non-standard journal entries to record non-recurring unusual transactions. Examples of such entries include consolidated adjustment. Hence, auditors should not test these entries as they are part of a standalone financial reporting process. And fourth one, in manual general ledger system, non-standard journal entries may be identified through inspection of ledgers. Hence, the same should be done by component auditor instead of principal auditor. First of all, whether any adjustment is required to be audited or not. Simple. In the current case, my question is, CKC was saying that no need to audit the adjustment, which they pass for the pertaining to valuation of inventory and provision in ANO Limited. You tell me whether the adjustment is required to be audited. Whether this adjustment is required to be audited. Pretty much easy, nothing difficult here. See, understand the concept over here. Like if there is any adjustment which has been passed, are we required to audit that adjustment? Are we required to audit that particular adjustment? That is very important to understand. Correct, Kaushiki. Correct, Soham. Correct, Boni. Okay. So before I go into the detail whether this is required to be audited or not, I want to talk about more onto the adjustments. Okay, more onto the adjustment. See how consolidated financial statements are prepared. Consolidated financial statements are prepared. By the way, you have a standalone financial statements. Each standalone financial statement is there, and then that standalone financial statement is then what do you say? Combined together to prepare a consolidated financial statement. For example, let's say in our example, so we have XYZ Limited, we have ABC Limited, we have then PBC, DBC, and ANO. I'll give you a simple example. Now, first of all, we need to understand from where this requirement is coming. That you need to have a same accounting policies or same accounting details. Now, that is given under Ind AS 110. Ind AS 110 talks about that how consolidation is required to be performed, how consolidation is required to be done. Okay. So there are paragraphs. If you want, you can this is the particular, I have kept the extract from Ind AS. Okay. So this is again pertaining to date. Just a minute. Yeah. So Ind AS 110, there is a paragraph that talks about for the adjustment. Okay. It's B85. So you can refer to B85 paragraph, B86 paragraph that talks about okay how consolidation procedure is required to be performed. Now, when I prepare this standalone financial statement, so for the first time, when I acquire a stake in PBC, DBC, or ANO Limited, for the first time, what I will be doing is I will be passing permanent adjustment. Okay, I will be passing permanent adjustment. What is permanent adjustment? So permanent adjustment are nothing but the adjustment that are there to account for, let's say, pre-acquisition reserves, goodwill, or minority interest, to non-controlling interest. So permanent adjustments are those adjustments which help us to identify the goodwill amount or non-controlling interest, which remains same year on year. They are permanent. That is one time, that will be there always in the consolidated financial statement. So permanent adjustment, let's say non-controlling interest, minority interest, goodwill, capital reserve, these adjustments will always be there. Once you decided the goodwill, it will going to be there in your financial statement. That is there. Okay, so that's a permanent adjustment. When you prepare the consolidated financial statement, what you need to do is you need to pass these adjustments. Okay. Then the next category of adjustments are current adjustment. So Ind AS 1110 talks about how to pass the current adjustment and how to consolidate basically. So there is a procedure given which says that you need to combine the like items, asset, liability, equity, expense. Then you need to offset the carrying amount of the parent's investment. Just a minute, I'll show you. Now, this is the extract of Ind AS 110. I'll not go into the much detail, just to explain you from where it is coming. Okay. So this talks about like, okay, what is the consolidation procedure? Consolidated financial statement you need to prepare by combining the like items, asset, liability, equity, income. You need to offset or eliminate the carrying amount of parents' investment in subsidiary and the parents' portion of equity of each subsidiary. Okay. Ind AS 103 explain how to account for any goodwill. This is my permanent adjustment. Eliminate in full intra-group asset, liabilities, equity, income, expense. What is intra-group? Simple. In my example, if I go into my example over here, let's say in this particular example, PBC and DBC were having some intra-group transaction. For example, PBC sold some goods to DBC. Now, in the books of PBC, there was a DBC was a debtor, and in the books of DBC, PBC was a creditor. Okay. So, in books of PBC, DBC was debtor, and in books of DBC, PBC was creditor. Okay. Now, when I talk about intra-group transaction means, first of all, I need to combine everything, combine my asset, liabilities, equities, and income. So when I will combine over here, what I'll do is the data, all the data I'll combine together. All data I'll combine. And here I'll combine all creditors. So what will happen in consolidated financial statement? That in consolidated financial statement, you will have certain debtors, you will have certain creditors, which are for the each other. Means I'm inflating the debtors and creditors. So in debtors, it will be DBC. In creditors, it will be PBC. But when you consolidate, there is no existence of the PBC and DBC. So what will happen is, in debtors, the company name will be their own company, and PBC own, like, you know, I will be, I need to collect it from myself, I need to pay it to myself. In consolidated financial statement, that is basically incorrect. So what you need to do is you need to eliminate this particular transaction. Okay, you need to remove this particular transaction so that you can have the debtors and creditors after intercompany or intergroup transaction. So that is eliminate full intergroup asset, liabilities, equities, expense, cash flow related transactions. Okay. Then comes the uniform accounting policies that you need to follow. If a member of a group uses accounting policies other than those adopted in the consolidated financial statement for like transaction, like in our example, inventory, okay, then appropriate adjustments are made to the group members. In our case, who is a group member? In our case, group member is a ANO Limited. Appropriate adjustments are made to the group members' financial statement in preparing the consolidated financial statement to ensure conformity with the group accounting policies. Group means all the rest of the entities, XYZ, ABC, PBC, DBC entities. Okay. So all the rest of the group's accounting policies. Now this is there. So this adjustment is required to be passed. Now, when this adjustment is required to be passed, you are required to audit that adjustment. In order to audit the consolidated financial statement, you need to understand which are these adjustments which are required to be passed, and then you need to audit those adjustments. So whatever adjustment can be, it can be, let's say, for intra-group, it can be, let's say, for your accounting policy related. Okay, so accounting policy adjustment. Or it can be your permanent adjustment. So all such adjustments are required to be audited. And for that, what you need to do? First, you need to understand an adjustment. What is an adjustment is pertaining to? Understand that. Obtain the sufficient and appropriate audit evidence for that. Okay. Whether the calculation or the amounts which are there for the adjustment are appropriate. So, in order to audit the adjustment, what you need to do is first of all, what you need to do? Understand the group structure. Why? Reason because till the time you don't have a clarity on the group structure, how can you identify which entity is required to finalize CFS, which entity is required to prepare the CFS, which entity is required to pass which sort of adjustment? Understand the group structure. Group-wide controls. Okay. IT systems. So all you need to understand, IT systems. Okay. And that will be which is related to consolidation process. You are not required to have a detailed understanding, like you are not required to deep dive in the entities. Let's say, for example, component. Let's say PBC Limited in our example. Okay. In our example, PBC Limited. Now, do I need to understand all the controls? I am the auditor of XYZ Limited. Okay. I am auditor of this XYZ Limited. Do I need to understand full controls of PBC Limited? Answer is no. That is a responsibility of the component auditor to understand the process, controls, everything of the PBC Limited. What I am interested is only the components related to the consolidation process. Sorry, controls related to the consolidation process. So whatever it is related to the consolidation process, it's group-wide controls, IT systems. Okay, I need to understand that. Number two, I need to understand the accounting policies of group and component. Then only I will be able to identify whether there is an adjustment required or not. I need to understand the group accounting policies and the component accounting policies. Then I need to understand the currencies used by group for reporting and used by component for reporting. So I need to understand the currencies used by group for reporting and used by component for reporting. So what if the components financial statement are in the foreign currency? I need to convert into the reporting group reporting currency. And let's say, for example, in our case, ANO Limited was preparing their financial statement in euro, rest all are rupees, INR. If rest all are INR, I need to convert this euro into INR financials. Then only I will be able to consolidate. Okay. Then only I will be able to consolidate. So first I need to convert that and then I will be able to consolidate. So that's something I need to understand the currencies. Okay. Once I'll do that, what I need to do is then simple. I need to determine the programming, the plan or nature, timing, extent of audit procedures, nature, timing, extent of audit procedures that are required to be performed based on the assessment done. So in nutshell, what we need to do is we need to apply SA 315 risk assessment, and based on that we need to create a response as per SA 330, okay, audit plan, and you need to address that risk. So it talks about applying SA 315 and 330 on the consolidation process. Clear? Then what we need to do is next step is we need to understand the extent of use of work performed by other auditor in the audit of consolidation, basically. Okay. Now, use of work performed by other auditor. That is nothing but application of SA 600 using the work of other auditor. Okay, I need to apply SA 600 and I need to understand how much of the work I can leverage over here. I can rely upon the other auditor. Okay. Then what I need to do is I need to coordinate with component auditor so that they can perform their audit appropriately. Now, this is the one I need to audit the adjustment and audit the CFS basically. How I need to audit the CFS. Plus, along with that, what I need to understand is I need to ensure the completeness of the components. So to understand the group structure, group-wide controls, IT system, for the first point, okay. To understand the group structure or group-wide controls, or to ensure that I have identified all the components, completeness of the components. What I will do, I will, to identify the completeness of the components, what I'll do is, first, I'll review last year's working papers where I have already identified certain components. I'll understand management's process to identify existing and new components. How management is ensuring that they have, identified all the components and they have prepared accurate consolidated financial statement. I'll understand components which are not required to be consolidated. Okay, that may be because of I lost the controlling interest, or that entity is exempted from, to be consolidated, or something like that. That entity is no longer has been dissolved or not part of my group. Whatever can be the scenario, I need to understand which components are not required to be consolidated. I'll review the investments of parent entity. Okay. I'll review the investment of parent entity plus joint venture agreements. Or other arrangements, other agreements or arrangements which can, guide me. Okay, there are chances that, I will be having some controlling interest on some of the entity. So I will be performing all these things to identify whether, any entity has been left out from consolidation. I will ensure the completeness by this way. So that is one of the points that we discussed. Then understand the group structure. How I need to understand the group structure by this way. Then I'll understand the accounting policies. Then I'll understand my, group reporting process. Other than this, what I can do is, other than this particular steps, I can also perform. I can also, review registers, maintained under Companies Act. Like register under section 186, 190. Okay, wherein I can identify something. I can review minutes of meeting of board, AGM, or other committee. To understand if there is any, they have identified any control or any such entity where they can exercise the control. So all these things I need to understand. Clear? Any doubt? Okay. So there is one question which says that if ultimate parent prepares financial statement based on different method, then all its subsidiaries, can we make adjustment in the ultimate parent? See, usually what happens is when there is a group, let's say for example this group X, Y, A, B, C, D. Now if X is using some different accounting policy than rest of the same, then for the sake of simplicity the X amendment itself will change. But if X management is not intending to change their accounting policy, then understand who is required to prepare the consolidated financial statement. X. If X is required to consolidated financial statement, then X accounting policies will become group accounting policy, and everyone needs to follow that. Okay, so the entity who is required to prepare consolidated, their accounting policy will be the group accounting policy, and that are required to be followed. What are group-wide controls? When I talk about group-wide controls, those are the controls on consolidation process. See, preparation of the financial statement is a job of management. I will not prepare consolidated financial statement. I'm here to audit it. Management will prepare consolidated financial statement. If management has to prepare consolidated financial statement, then what they need to do is they need to have a process of consolidation wherein they will prepare the financial statement. Now in the process of consolidation, what is required is they might have some controls, okay, that all the components are considered. They might have a control, okay, all the intra-group adjustments are identified and eliminated and passed, all the necessary adjustment, permanent or temporary or current adjustment are passed. So there is a consolidation process which may have consolidation controls. Those are the group-wide controls we are talking about. Yes, SA 600, if you see, it's about basically my what do you say? SA 600 talks about using the work of another auditor, which includes the component auditor. Okay, there is one question. Can investment entity choose to prepare CFS? If so, then its subsidiaries are exempted from preparing CFS. See, if the goal is the parent company should prepare the CFS. If the investment entity is a parent company, if they are not going for the exception, they are still preparing the CFS, fine, let them prepare. There is no problem. And if the parent company is preparing the CFS, then the subsidiaries can take the exemption. Provided rest of the conditions are fulfilled. They are not listed, then these conditions are required to be fulfilled. That they have already obtained the approval from its members that they are not preparing the consolidated, company doesn't have the security listed, ultimate or intermediate holding company files the consolidated financial statements. If these conditions are satisfied, then only subsidiary can take. Clear? Any doubt? Okay. So there are various adjustments that are required to be passed in a particular, consolidation process. It's not a few adjustments I'm just talking about. Adjustment like, unrealized profit, deferred tax. Okay. Then in cases of, what do you say? Goodwill, capital reserve, non-controlling interest. Then there are other adjustments also related, related party transaction related adjustment that are required to be passed. Okay. And consolidation requires a lot of adjustment, because let's say, for example, if you have multi-step consolidation, like this way, like first, C Limited will prepare a consolidated financial statement to consolidate DA and DB. Then this consolidated financial statement will be used by Y Limited along with AB and D Limited to prepare its Y Limited consolidation. And then it will go to the X, like this way. Okay. So if it is multi-level, multi-layer structure, then adjustments are passed at each level, at C Limited, at Y Limited, at X Limited, at each and level. Consolidated adjustment will be passed, and then a group-wide final consolidated financial statement are made ready. Okay, so that is basically consolidation adjustment I'm talking about. Okay. Then there is one more adjustment that you need to account for. Okay. You need to account for subsequent events. Now, one of the adjustment, it is their subsequent event, wherein what will happen is, let's say if there are any events that have occurred, okay, like like existing event, that the evidence was available on the date of financial statement, and there has been change or something like that. So impact for those existing event. If they are non-adjusting event, then you need to provide the disclosure in the in financial statement. So in both of the cases, you need to provide for the subsequent events. So adjustments for subsequent event, that can be adjusting and non-adjusting in the financial statement. And accordingly, you need to audit those one also. So whatever adjustment I'm talking about, you need to audit those adjustments. Okay. Any doubt till now? Any doubt? Okay. So again, I'll go to the exemption. So I'll explain you the exemption. What exemption says that? So exemption says that if you are a subsidiary, if your parent is preparing consolidated financial statement, if your parent preparing consolidated financial statement, you have taken approval from all the members that you will not prepare financial statement, and your securities are not listed, then you are exempt. Then you are exempt, basically. Okay. So let's say, for example, if a company has a parent company, if that is preparing consolidated, and if the subsidiary doesn't have their securities listed, then they can exempt themselves by taking the approval of the members. But if the subsidiary has its security listed, then they are required to prepare financial statement, consolidated financial statement. Now, the second level of exemption comes is, if an entity is exempted to prepare consolidated financial statement under accounting standard. Now, which are the entities which are exempted under accounting standard? Is one, if it is an investment entity. If it is an investment entity, then that particular entity is not required to prepare the consolidated financial statement. Okay. Now, you need to understand how it works. Let's say, for example, I'll take this example. Let's say this is an investment entity. Now, if this is an investment entity, this entity has an exemption under Ind AS. If this entity has an exemption under Ind AS, then what it says that if any entity has an exemption under AS, then they are required to only comply with Schedule 3. So, sorry, this entity will only prepare Schedule 3 to comply with consolidation requirement. Perfectly fine, no issues. Now coming to Y Limited. Now, Y Limited is not an investment entity. Not an investment entity. Now, if Y Limited, whether Y Limited needs to prepare the consolidated financial statement, so I need to check three things. One, approval from member. Let's say I have. Second, securities not listed. Let's say I have. Third, my parent should prepare CFS. In this case, is my parent preparing CFS? No, because my parent is claiming exemption of the investment entity. This is not there. If any of the one is not there, I cannot claim the whole exemption. I need to prepare consolidated financial statement to be prepared. So Y Limited will prepare the CFS. Understood the logic, how it works? Same way, if Y Limited was an investment entity, then X Limited would have required to prepare CFS because X Limited doesn't have any parent who should prepare CFS. In that case, it will become X Limited responsibility to prepare the CFS. Clear? Any doubts? Any doubt till now? I hope, Kaushiki, your doubt is cleared now. Okay. If no doubts, what I suggest is let's take a quick 10-minute break. We'll gather back after the break and we'll discuss the rest of the part for the consolidation. Okay. Let's take a quick 10-minute break. Nisar ji, Okay. Hello everyone, welcome back. So we discussed the exemption and the investment structure and the group structure, how it falls, who is required to prepare consolidation. We saw the audit adjustment, how we are required to audit those audit adjustments. Okay. So we went through and discussed all these things. Okay. Now, the next part I want to discuss is I'll go to the MCQ. Okay. Is this one. So XYZ Limited, sorry. XYZ Limited passed necessary adjustment to align the financial statement of ANO Limited that were drawn up to different reporting days compared to the financial statement of XYZ Limited. Okay. Now there is an additional information which is given that the financial year of ANO Limited is a calendar year, that is 1st Jan to 31st December, whereas for the rest of the company it is 1st April to 31st March. So what is saying here is in this question, XYZ Limited passed necessary adjustment to align the financial statement of ANO Limited that were drawn up to the different reporting rates compared to the XYZ Limited. CKC and company were of the opinion that such adjustments are not required to be audited and they need to audit the original financial statement for the period ending on 31st December 2021. Kindly guide the CKC and company for auditing the consolidated adjustment. Now, what are the options over here? The financial statement of the component used in the consolidation should be drawn of the same reporting date as of the parent. If it is not practical to draw up the financial statement to such date, and accordingly those financial statements are drawn up to different reporting dates, then the adjustment should be made to effect the significant transactions, other events that occur between those date and the date of parent financial statement. The financial statement of the component used in the consolidation should not be drawn up to the same reporting date as of parent, as it is not practicable to draw up the financial statement to such date, and accordingly those financial statements should be kept as it is. Third, financial statement of parent should be drawn up to same reporting date as of that component. If it is not practical to draw up the financial statement, adjustment should be made for the effects of the significant transaction and events that occur between the date of component financial statement. Financial statement of the parent and the component used in the consolidation should be drawn at the end of calendar year, irrespective of their reporting dates. So what is the correct option over here? So we are talking about they have a different reporting date for the financial statement. Now, what should be done when there is a difference between reporting date and the financial statement? What should be done? XYZ has a different reporting date, ANO has a different reporting date. What you should do? Correct, Kaushiki? Come on, guys. What you should do in that case? They have a different reporting date. ANO has different, XYZ has a different. So, what they should do? Should they draw up to a same date? And if same date, whose date should be? Group, component, parent or component? Pretty much simple. So the question is that XYZ has a financial year as their accounting year, and ANO has a calendar year as their accounting year. Now they want to prepare the consolidated financial statement where ANO will get consolidated. If ANO will get consolidated, but they have a different period of accounting, what they should do? Correct, Soham? So here, so Soham and Kaushiki, one question to you. Why not C? Those who have an answer as A, my question is why not option C? Correct, Soham. See, so here, what is the scenario is, if there are different reporting dates, okay, then consolidation procedure asks us to do something. That is, if the financial statements of the parent and its subsidiary used in the preparation of consolidation financial statement shall have the same reporting date. When the end of the reporting period of the parent is different from the subsidiary prepares for the consolidation purpose additional financial information as of the same date of the financial statement of the parent to enable the parent to consolidate the financial information of the subsidiary, unless it is impracticable to do so. If it is impracticable to do so, the parent shall consolidate the financial information of the subsidiary using most recent financial statement of the subsidiary, adjusted for the effect of significant transactions or event that occur between those financial statement and the date of consolidation of financial statement. So either parent should prepare a same financial statement as of the parent's reporting date. If that is not practicable, then parent should take the financial statement of the subsidiary and pass necessary adjustment. In the current case, A says that the financial statement of component used in the consolidation should be drawn up to same reporting date. That is correct. So components financial statement should be drawn to the same reporting date. If not practicable, then pass adjustment. C says that the financial statement of the parent should be drawn up to the same reporting date as of component. That is wrong. I need to do components to the parent, not parent to the component. So that is wrong. B says that financial statement of component used should not be drawn. That is also wrong. And D says that the financial statement of the parent and component should be drawn at the end of calendar year. That is also wrong. So the correct option is A. I hope it is clear. So the correct option in this example is A. Reason because if there is a difference in the financial statement reporting date, you need to align to the parent's reporting date, or prepare a new financial statement of the parent's reporting date, or else pass the adjustment. Now, when it comes to the adjustment, if any adjustment is required to be passed, you are required to audit that adjustment. Clear? See, India has prescribed what management has to do. If management has to do something, then you have to audit that particular thing. So you should be aware that, okay, what are the roles and responsibilities of management with respect to the consolidated financial statement? How they are required to be prepared. Okay. Now comes to the very important part of the consolidated financial statement is reporting. We were talking till now, auditing the adjustment, identifying the components. What is the consolidated financial statement? Now you audited, now you identified, everything is done. Now we need to understand how to report for the consolidated financial statement. What should be our audit report? For that purpose, I'll show you something. I have a live audit report that can be used as an example. Just let me bring it to the screen. This See, I'll request not to focus on the name. I'm not, focusing on the name of the company. I just take one example, okay, which is available on the public domain. Okay. Now, before I go to the reporting, let's take one more MCQ on reporting, and then on the basis of that, we'll discuss. CK and company reported the following in their audit report for XYZ Limited on other matter para. Okay. What they reported is we have audited the financial statement and other financial information in respect of 4 subsidiaries whose financial statement include total asset this much CR as on 31st March, total revenue this, and net cash outflow this for the year ended of that date. And these numbers 535,992 and 776 are coming based on the additional information which is given over here. So following is the extract of the financial statement of all the entities. So what they have done is they have taken total of this in the revenue. They have taken the total of expense asset in the asset one and the cash flow in the cash flow one. And what they have said is we have audited the financial statement and other financial information in respect of 4 subsidiaries, that is ABC, PBC, DBC, and ANO, whose financial statement include total asset of 5835 CR, total revenue 992 CR, and total cash outflow of 766 CR. Let's not go to the option. Without option, you tell me what is the issue over here. Without going to the options. Without going to the options, you tell me what is the problem in this particular reporting. Okay, Kaushiki. Okay. Let's say this is one of the para which is there in other matter paragraph in audit report for the consolidated financial statement of XYZ Limited. So this is one of the extract of that one paragraph. Okay, for further understanding, let's say these numbers are there, and let's say for ANO Limited, this is for April to March. That has been after adjustment. Let's say for ANO, this is after adjustment. Simple. The question is that this particular line has been provided in the audit report by CKC and company. What is the issue in this particular line of reporting? This line that has been reported. Okay. Now, AOC1 is not the correct answer. We are not talking about AOC1. I'm talking about audit report. AOC1 is something different that is required to be filed by management, not the auditor. AOC1 is the responsibility of the management where they need to provide the silent features. I am talking about auditor over here. Auditor has reported this particular line in their audit report. What is the issue in this line? Pretty simple. It's on the face of the line. I will tell you. It's on the face on that particular paragraph that is the issue. No complications. Nothing is more complicated over here. Okay, I'll tell you. We have CKC and company reported that we have audited the financial statement and other financial information is respect of they have audited the financial statement and other financial information of 4 subsidiaries. And when I say we have here, they have written like we have audited. Who is the we? CKC and company. So CKC and company is saying that they have audited 4 subsidiaries, that is ABC, PBC, DBC, and ANO Limited, which is not correct. Absolutely, Boni. Correct answer. Which is not correct. PBC and DBC were audited by there was another auditor named NKL and company. Sorry, NKL. So NKL and company was their statutory auditor. So here this has been audited by NKL and company, whereas ANO is not audited. See, initially we discussed this particular thing that ABC Limited and XYZ Limited were appointed CKC. However, PBC, DBC appointed NLK and ANO was not audited by any auditor. If that is the case, then do you think this line is correct? Where CKC is saying that, okay, I have audited all the 4. We have audited the financial statement and financial information of all the 4. Do you think this line is correct in that case? If that has been audited by another auditor, if one of the component is not audited, do you really think this line is correct? Answer is no, this is not. Okay. So if this is not correct, what should we report in the current case? How we should report? If this is not correct, like, okay, I am saying I am not, like, in actual, I am not audited. I am just consolidating. I am consolidating the 4 of the subsidiaries. Out of that, 1 I have audited. Rest 3, I don't know. My another auditor has audited. I am relying upon the another auditor as per SA 600 after performing certain procedures. ANO even is not audited. What should I do? What should I do in the current case? So when this is a scenario, okay, when basically all the components are not audited by the principal auditor, then what should be done? Okay, so let's go to the discussion on this particular point. Different auditor. Okay, now I will be talking about different auditor basically. Okay, so what should be done when the auditor is different? First of all, we need to understand which type of can be scenarios. Which scenarios can be there? Auditor of parent is same as auditor of component. Okay. Auditor of parent is same as the auditor of component. In second scenario is auditor of parent is different than the auditor of component. Okay, these can be the two scenarios. Auditor of parent either can be same, either can be different. If the auditor of the parent and auditor of the component is the same, then there is no issue. Both are same, no issue. In that case, they can directly issue opinion on consolidated financial statement, even no need to mention any paragraph or any other thing. Okay. No need to provide other details. Fine. This is not a problem for us. If both the auditors are same, not a problem for us. That I know. Okay. That we are good on that cloud. But if there is a different auditor for the component, what we should do? Now, then we need to understand, first of all, whether component auditor, okay, follows different accounting policies and GAAP. Let's say, for example, ANO. In Cyprus, they have IFRS. They don't have NDS. So they are following different accounting policies and GAAP. If that is the case, what we need to do is, first of all, if that is the case, then what we need to do? If no, like, they are following NDS, they are not following anything else, then fine, there won't be an issue. What we need to do is, in that case, we need to refer to SA 600, plus we need to understand, okay, in that case, what we need to do is, we need to refer to SA 600, plus we need to understand the audit procedures performed by component auditor, okay. I need to provide, so parent auditor needs to provide component auditor group and component materiality. I need to provide him group and component materiality, so that he can understand what is material for me as a consolidated financial statement. Okay, I'll come to this topic of the materiality. That is the topic I need to discuss. Okay, Plus, along with that, I need to mention the details in other matter para as per SA 706 that I have relied upon another auditor. That I have relied upon the another auditor. Okay, so I will disclose that these components are not audited by me. So I'll mention that in other matter paragraph that these components are not audited by me. Simple. However, if the accounting policies are different, so the first step I need to do is harmonization. That is, I need to harmonize the accounting policies. For example, inventory valuation and provision in our last example, different accounting policies. I need to harmonize the accounting policy to the group accounting policy, or in other words, I need to align or pass adjustments. I need to audit those adjustments. Management will pass that. I need to audit those adjustments. Okay. Once I'll audit that adjustment, then again, same procedure. I'll refer SA 600 for the rest of the things. I'll understand the procedure performed by the component auditor. I will provide him the group and component materiality. I'll mention the detail. This is not audited by me. Clear? If now, whether component auditor follows different auditing framework, now it can happen that they are following different auditing framework. For example, they are following the auditing framework wherein auditing standards or engagement and quality control standards are not applicable to them. What will happen in that case? If the component auditor, let's say in Cyprus, they were altogether different set of auditing standards, what you will do? First of all, if it is no, basically, so it will be same as no over here. If it is no, then this no will be applicable. Okay, like SA 600, ILC, everything is fine. But if they are following different, then as a parent, I'm talking about as a parent auditor. Okay, not as a component auditor. I'm talking about these things are required to be done by parent auditor. So as a parent, what I need to understand is, I need to understand whether the requirements of parent, as in my auditing framework, has been fulfilled. So for example, let's say I compare both of the auditing framework and I identified, okay, although they have a different auditing framework, it's on the same line that, understanding the entity, its environment, risk assessment, materiality, all the things are on the same line. Fine. So if that is on the same line, I need to understand. And if it is on the same line, then not an issue. Again, if on the same line, if same, then again, what I'll do is this one. I'll refer myself again to here. That SA 600, understand the procedures, everything. If same. If not, then what? I need to ask component auditor to perform additional procedures for the purpose of consolidation. Okay. I need to ask component auditor to perform additional procedures. Please perform these additional procedures, because from the consolidated reporting purpose perspective, I need these procedures to be performed and need this assurance to be obtained. Clear? So that is how it is required to be done. Now, there are two important things in this. First of all, I told you materiality, group materiality and component materiality. So group and component materiality is something, we calculate on the basis of group, you can say, just a minute. Okay, group and component materiality is something that is, is based on the total numbers, is based on the group numbers, like group revenue, group asset, group liability, or whatever. Group numbers is based on that. Okay, now why materiality and group materiality is important, I'll tell you. When I'm auditing the consolidated financial statement, first of all, what I need to do is I need to identify group materiality. This materiality helps me to understand the you can say how much any observation, okay, to understand the criticality of the observations at consolidated financial statement level. Means what? For example, let's say I identified an issue. Okay, I identified an issue which can be material from the individual perspective, individual standalone financial statement perspective, but it is not material from the group perspective. For example, let's say I'll go to the previous example, XYZ, ABC, PBC, DBC, and ANO. In ANO, I identified an observation, let's say, of rupees 2 CR. However, this is observation. However, my materiality is based on the group revenue, total revenue. It is, let's say, of 5% of group revenue, which is equal to, let's say, for example, rupees 250 CR, because the group revenue was so big that the 5% of group revenue was 250 CR. Let's say it has a highest, coming from here, ABC, like here, PBC here, DBC here. So now this 2 CR observation, do you think that is sufficient enough, or that observation is so material that I need to qualify my group consolidated financial statement in front of this 250 CR? Answer is no. So group materiality helps me to identify that if I identify any observation in consolidated financial statement, whether that is that much material that helps me to, that asks me to qualify or modify my opinion, what should be the impact of that particular observation, that is I can understand through group materiality. Okay, that is the one purpose of the group materiality. Second use of group materiality is to identify whether any component is material for the purpose of audit, for consolidated financial statement. Now, for example, I'll take this example again, XYZ, ABC and everything. Okay. Now, here, as I told you, the group materiality is 250 CR. I'll take the same example. Now, the total revenue for this entity is, let's say, 3 CR. Total asset, let's say 5 CR. Total liabilities, let's say 4 CR. Profit after tax is, let's say, 0.5 CR. Now, this particular entity, A&O Limited, is material for me, for as a group as a whole. When I have a group materiality of 250 CR, let's say I ignore this entity altogether, like I do not audit, I do not express any opinion. Still, I can say that, if I get opinion on the rest of the name, ABC, PBC, DBC, I can still say that, okay, on a material aspect, my financial statement gives the correct and true and fair view, because the materiality lies here, not here. So if I do not audit A&O, still I'm fine, perfectly fine. Reason because that is not a material chunk for me. If I leave this out, I'm still fine. So group materiality helps us to identify whether any component is material for the purpose of audit for the CFS. Like in the earlier one, if there is a different auditor and if they are using different framework for auditing, in that case, I need to ask them to perform additional procedure. But that is only when that particular component is material. This is only when the component is material. Otherwise, why will I ask them to perform additional procedure even when the component is not material for me? So I need to understand whether my component is material enough to be considered for the audited, to be considered for the CFS or not. That is, I can get through the group materiality. Now, second comes is component materiality. Now, what is component materiality? Okay. Let's say, for example, A&O Limited. A&O Limited is getting audited because auditor is there. Now, auditor asked me, okay, what do you want to see? The component auditor came to me and asked me, what do you want to see from the observation? See, A&O might have a standalone materiality altogether different. Let's say 3 CR is the total revenue for A&O. So if I multiply 5% to 3 CR, I'll get somewhere around 15 lakh rupees. Okay. As a materiality, standalone materiality, I call it standalone materiality, or you can say SM as of now. Okay. So if this standalone materiality is 15 lakhs, so what he will do is any observation above 15 lakhs will be reported in the audit report. Now let's say there is an observation of rupees 20 lakhs. Okay. Now this observation, do you think is good enough for me to actually look from the group materiality of 250 CR, observation of 20 lakhs? Do you really think that will be sufficient for me, like enough for me to look into as a group or consolidated financial statement level? Answer is no, that is not material. even that may not impact my financial statement or opinion on the consolidated financial statement. It may happen that, individual level, the financial statement or the audit report on the financial statement may be modified for ANO Limited, but at the group level, I may not choose to modify. Reason because XYZ, ABC, PPC, DBT, that is the material chunk, is fine. In that case, what I need to do is I will give a component materiality to ANO Limited's auditor and will say, see the auditor, I'll call the ANO Limited auditor and I'll say, see, this is your materiality. This is the materiality I'm allocating to you. If any observation is above this level, then come to me and inform me that observation. So component materiality helps the component auditor to report observations which are critical from audit of CFS point of view. Okay, so that he will use to report the observation. Okay, that is the where materiality plays their role. Very important to understand the materiality. We will understand how we calculate in the materiality, or the details of the materiality when we see standards on auditing. Over there, we look into there is an essay 320. Materiality. Okay, in planning and performing an audit, we look into more detail on materiality in that particular essay. Now the question is it practically possible to ask foreign component auditor to perform additional procedures? Yes, that happens. I'll give you an example. Okay, I'll give you one example. Let's say the companies which are SEC listed, US companies, their parent and group is in US. The US auditor most of the time ask Indian auditors to perform additional procedures for the reporting, for the additional reporting requirement which is there for the SEC or PCAOB which is there in the US. If that entity is required to report to the SEC or PCAOB, okay, then the US auditors requires Indian auditors to report accordingly some additional information which will be helpful for them to report to the SEC. So yes, that is there, and that is known as a group reporting. So that happens. Okay, now I'll show you one of the things. Consolidated audit report on the consolidated financial statement. We saw we are required to give other matter paragraph. Okay, we discussed that. I'll show you how it is there. So this is simple audit report, which is like any other audit report. Okay, report on the financial statement, opinion. This is report on the financial statement, opinion is there, the whole opinion, then the basis of opinion. Okay, then key audit matters might be there. I'll skip the key audit matters, no need to go into a detail as of now. Okay, information other than financial statement and audit report thereon, we'll see when we'll discuss essay this one, other information. Okay, management responsibility on the consolidated financial statement, auditor's responsibility on the consolidated financial statement. If you see the auditor's responsibility, okay, you will see everywhere, we are mentioning consolidated financial statement. We need to identify risk of material misstatement at the consolidated financial statement. Okay. So again, everywhere it will be, reference given to the consolidated financial statement. So all the responsibilities are work in that way. Okay. Other matter paragraph, very important, that I'm going to discuss. See, the accompanying consolidated financial statement include the group's proportionate share in jointly controlled net assets of this much crores in respect of two unincorporated jointly controlled entities not operated by the group, which is based on unaudited statements which have been certified by the management and relied by upon us. This was for the jointly controlled entities. Now see, the accompanying consolidated financial statement include financial statement of 122 subsidiaries which reflect total asset of this much CR 31st March and total revenue of this much CR and total profit of this much amount, total comprehensive income of this much amount and net cash flow of this much amount for the year ended then, which have been audited by other auditors. Audited by other auditors, not by us. Whose financial statement, other financial information and auditor's report have been furnished by us, furnished to us by management. So we have received that information from other auditors. Our opinion on the consolidated financial statement so far relates to the amount and disclosure included in respect of these subsidiaries is based solely on the reports of other auditors. That is, we are talking about SA 600, means we have relied upon the work of another auditor. That is, our opinion is solely based on the reports of other auditors. Same way, this is for the jointly controlled entities. Okay. Then see, the accompanying consolidated financial statement include financial statement of 16 subsidiaries, which reflect total asset of 10 crores, 31st March, total revenue of 1.32 crores and total loss of this much, comprehensive of this much, total comprehensive loss this much, net cash flow this much, for the year ended, whose financial statements are unaudited and have been furnished to us by the management, and our opinion on the consolidated financial statement so far relates to the amount and disclosure included in respect of such subsidiary is based on the such unaudited financial statement. In our opinion, and according to the explanation and information given to us by the board of directors, these financial statements are not material to the group. Now, how can I decide this is not material? Based on two things. One, in order to decide whether these components in total together are material or not, I need to see group materiality. Group materiality helps me to identify whether the unaudited components are material enough or not. So this not material comes from the group materiality. See this one also. Some of these subsidiaries are located outside India, whose financial statement and other financial information have been prepared in accordance with the accounting principles generally accepted in their respective countries, and which have been audited by other auditors under generally accepted auditing standards applicable in their respective country, like A&O Limited. In our example, the parent management has converted these financial statements of subsidiaries located outside India from accounting principles generally expected in their respective countries to accounting principles generally accepted in India. So adjustments, current adjustments we are talking about. We have audited these conversion adjustments made by the parent's management. Our opinion insofar relates to the balance and affairs of such subsidiaries located out of India is based on the report of other auditors and conversion adjustment prepared by the management and audited by us. So we have audited the adjustment prepared by the management. But other than that, we have relied upon the report of other auditors. So SA 600 plus audit of current adjustment Now, this is again for the jointly controlled entities and associates which are unaudited. Same. So those are, based on the unaudited financial statement and are not material to the group. Again, not material means group materiality. See, one important point. Attention is drawn to the fact that some of the subsidiary companies are incurring continuous losses and have a negative current assets position. However, the financial statement of these subsidiaries have been prepared on going concern basis, considering financial support from the parent and fellow other subsidiaries. Why this is there in the other matter paragraph, not in going concern paragraph? Can anyone tell me why it is reported over here? Why it is reported over here? Not in going concern paragraph in main audit report. Why they have reported this in other matter paragraph? Come on, guys, pretty easy. Why this is not reported into a separate paragraph, rather being reported into other matter paragraph? Absolutely correct. Kaushiki, absolutely correct, Ditiman. The reason because this is for certain of the subsidiaries, companies that have a negative cash flow, that is not material to the group as whole. If that is not material to the group as a whole, then how can I say that, okay, for example, A&O Limited is doing cash losses. I have a doubt on going concern. Okay. I have a doubt on going concern. In my earlier example, A&O Limited is loss making. Can I say that because A&O Limited is loss making, the whole group of XYZ Limited has a going concern issue? Answer is no, I cannot. Reason because the materiality of the A&O Limited and the materiality at the group limited is altogether different. A thing might be material for the A&O Limited on a standalone level, but will not be material for a group as a whole. That's the thing it is reflected over here. That's why it's reported in the other matter paragraph, not on the going concern, because this is not an issue on going concern of the group, but it's an issue of the going concern of a subsidiary. And that's where the another concept comes in, the component materiality. So each component is awarded a particular materiality, is allocated a particular materiality. And based on that, they report any item. And if any item is reported over and above that materiality, then I consider that particular item in preparation of my audit report for the consolidated financial statement, and I assess the impact accordingly. The another classic example of the materiality. Okay, so then that's a other reporting legal requirement, and that is there, like all the things will be there, fine. That is okay. This is annexure A. Remember when we discussed the CARO, there was a clause in annexure in CARO in paragraph 3 that requires us to report that which are the clauses which have a negative comment in each of the subsidiary. That is the one. Okay, so that's there. Okay. Now, another area that I want to discuss is, let me present this to the screen. Just give me a minute to present to the screen. Okay. So remember, we were talking about Schedule 3. That Schedule 3, we are required to provide details of Schedule 3 in certain cases. So what Schedule 3 says that Schedule 3 requires us to report the matter in a specific format. Okay, where we are required to provide the details, whether it's like name of the entity, the share in total asset, share in profit and loss, share in other comprehensive income, share in total comprehensive income for entity wise, joint venture wise, every detail in that. Okay, we are required to provide that detail in as per Schedule 3. Okay, now in some of the cases, we were not required to prepare the consolidated financial statement, but we were required to provide that detail as per the, what you say, Schedule 3 additional requirements that we are required to comply. So let me check if I have a live example to show you guys on that. Just give me a minute to show you. Okay. Yeah, here I have. Apologies. So one of the example that I'm going to show you is based on that, like, Schedule 3 requirement. Okay. So now as I show you, Schedule 3 requires us to disclose net asset of the total minus liabilities, share in profit and loss, share in comprehensive income, share in total income for each of the subsidiary. Let's say here it will be ABC, PBC, DBC, like this way. So, okay, I need to provide all the details over here accordingly. I need to provide the percentage also. I need to give the amounts. So percentages of total net assets, percentages of consolidated profit and loss, percentage of comprehensive income, everything this way I need to provide as per the Schedule 3. Okay, this is the requirement of Schedule 3. Now I'll show you one live example. Okay, see, this is additional information of net asset, share in profit contributed by various entities as required under Schedule 3 of the Companies Act 2013. So net asset, that is net asset, total asset minus liability, share in profit and loss account, share in other comprehensive income, share in total comprehensive income, percentage in CR, percentage in CR, percentage in CR. Again, same way they provide for each and every entity this detail. This is first for subsidiaries that is there. Then you will have a for joint ventures. Same way, like this way, it is required to be given over here. Now, another thing I want to show you guys is this is the as per Schedule 3. Okay. Just give me a minute. Sorry. Another thing I want to share is one good example over here. Just give me a minute to bring it to the on screen. So I am going to show you guys AOC1, how AOC1 is reported by a company. Okay, like it's a live example wherein we will be seeing AOC1. Okay, so this will be the live example for the AOC1, how AOC1 is reported. Share my screen so that you guys can see. Yeah. So this is how AOC1 is reported. Remember, we were talking about all the details in the summarized format. So these are the details which are there in the summarized format for AOC1. Part A for subsidiaries, Part B for different reporting period, currency, share capital, other equity, everything is there. Total asset, total liability. Okay, then investment, sales turnover, profit and loss, profit for taxation, after taxation, percentage of shareholding. This is the AOC1 detail. This is how it is presented. This is also filed to the MCA, but it is also provided by the management in the financial statements. This is for the subsidiaries, reporting period, currency, everything is there. So you can go and you can check for AOC1. See, this is my list of subsidiaries, part of AOC1. This is now part B for joint venture and joint control entities, associates and joint control entities. Remember, there were two parts. So this is part 2. This is how it is given in AOC. I hope it's clear now. Okay, this is how the AOC is given. So this was basically the schedule 3 plus requirements plus reporting auditing means other paragraph reporting requirement. Also we saw AOC1 live example, how it is AOC1 reported. Okay, this was AOC1. Now, so this whole as a materiality and all other topic is based for the audit of consolidated financial statement. Any doubt till now? Any doubt with respect to any of the topic? With respect to any of the thing till now, whatever we discussed? Any doubts? See, it's very, very important to understand how reporting works, because there are two parts when I talk about audit of consolidated financial statement. Part 1, where you need to understand what you need to audit. Part 2, where you need to understand what you need to report and what management needs to report. Simple. You need to report that we discussed that, when there are different auditors, how you need to understand each and every area that we saw in the audit report example also, that how they are, mention those details in their audit report. This here, other matter paragraph, based on materiality, based on, different auditors, being audited by us, being audited by other, correct? But when I talk about management, we saw Schedule 3 requirements, we saw AOC 1, how management needs to report. Preparation of Schedule 3, preparation of AOC 1, requirement of the management, we need to audit that. We need to understand that all the details provided in those forms, in those silent features, in Schedule 3, in consolidated financial statement are appropriate, give a true and fair view. For that, we need to audit based on these procedures. Any doubt? Now I'll go to the MCQ. Now, in this example, where there was one paragraph which we discussed that is incorrect. So options are, just we'll quickly go through the options. When the principal auditor has to base his opinion on the financial information of the entity as a whole, relying upon the statement and reports of the other auditor, his report should state clearly a division of responsibility for the financial information of the entity by indicating the extent to which financial information of component, okay, financial information of the component audited by other auditors have been included in the financial information of entity. Example, the number of divisions, branches, subsidiaries, other components audited by other auditor. That is the correct answer basically. So whenever we have to rely upon other auditor, we need to mention that detail in our audit report. Clear? Any doubt? Any doubt till now? Okay. If no further doubts, then we will also cover one more MCQ that's there. Okay. CKC and company computed the consolidated materiality at 5% of the total revenue of XYZ Limited, ultimate holding company. That is 51.25. That is comes to like 1025 into 5%. And this 1025 is standalone. That is 51.25. And that was given to all components. Now, NKL and company's statutory auditor for the two of the subsidiaries contended the materiality calculated by CNK and company should have been based on the total consolidated revenue instead of the revenue of XYZ Limited. Kindly guide CKC and company with respect to the correct calculation base for the consolidated materiality. So how the consolidated materiality is required to be calculated, guys? We just discussed. So how do you calculate the consolidated materiality? Absolutely correct, Soham. How you need to calculate the consolidated materiality? Simple. Whatever base we will be taking the base of the group as a whole, not the individual. So if I want to calculate a consolidated materiality, I need to look for the total of the revenue or expense or asset. It should be based on group or consolidated benchmark instead of standalone benchmark. So in the current case, if I just take the standalone benchmark, that will give me incorrect consolidated materiality, or rather not incorrect, on a lower level. If I get a materiality on a lower level means I need to audit more, to gather more audit evidence, and to even I need to perform a lot audit more, that will be inefficient. Let's say, for example, if I take the materiality 100 rupees, see my words. If I take a materiality 100 rupees in XYZ Limited, where they have a total revenue of 1025 CR. If I take a materiality of 100 rupees, that means each and every item over 100 rupees, I need to audit it. Do you think that's an efficient audit? Answer is no. In that way, if I keep my materiality very low, that will not be an efficient audit. So accordingly, I need to see which is material, what is appropriate benchmark, that should be group or consolidated benchmark, and on the basis of that, I need to calculate the group materiality. Any doubts till now? Any doubts? Okay. After this lecture, I will be uploading these notes also onto the portal. You can download it. Guys, after this lecture, please go back and revise everything what we discussed. In the next lecture, I will be starting fiscal audit. Okay. Please be prepared with that particular topic. Read it in advance so that you can have a clear understanding. You can ask questions. And even for that, this topic also, if you have any questions in the next lecture, please feel free to ask. Very important. Okay. Please provide your feedback, what you like, what you didn't. I hope you enjoyed the lecture. So please provide your feedback, and I'll see you in the next lecture then. Okay. Thank you.